There was a lot to unpack in that jobs report that we got this morning. It's Friday, August the 7th, and this is Markets with Megan. If you like this podcast, you can subscribe to it. There's an alarm bell you can hit. Also, share it with any of your friends, family, colleagues, anybody who likes to look at those headline economic data pieces that we get and then dig down and see what it means for your investments. What does it mean for the economy? Well, this morning we got one of the most anticipated reports we get every month, and that's the jobs report. This is the jobs report for July, and it was a surprise, a big surprise to the downside, unfortunately. The expectation was that the U.S. economy created 80,000 jobs in the month of July, which was already relatively weak. But in fact, the data came in with the economy actually lost 23,000 jobs. And the prior 2 months actually were also revised lower. So very weak on that headline perspective. But let's dig into some of the details within that report. There was strength still in the construction and manufacturing side, so it's still adding jobs there. And that's primarily that AI build out that we're getting. Trade, that was down, and also the financial sector was down. But where we really saw some of the noise in this was in leisure and hospitality. That was actually lower. It could have something to do with the World Cup winding down the month of July. Maybe tourism wasn't as good as was anticipated, so they had to lay off some of those workers. We also saw government jobs decline. That had a lot to do with the local governments, though, because there is a lot of volatility that we see in the summer months within education. Now, when we look at the unemployment rate, though, that did fall. So it is kind of difficult to understand, if we shed jobs, how come the unemployment rate fell? Well, the unemployment rate fell to 4.1%. It is actually the lowest level that we've seen in about a year. And that's because there was a big reduction in the workforce. So when you leave the workforce, that unemployment rate can actually go down even with a shedding of jobs because there's less people in that pool of workers. The labor force participation rate actually fell to 61.4%. And that is, if you take out the pandemic related noise that we had in these labor market data pieces, that's the lowest level that we've seen since 1976. What we make of that, we're not sure. It's 1 month, so we'll see if this becomes a trend. But we do know that there were some big layoffs over the past couple months. Some of these layoffs in some of the bigger companies, we talked about at Microsoft. If these companies are offering out severance packages, or people just waiting on the sidelines before they go back and re-enter the workforce after they've been laid off, we're not sure yet, but that could be what's impacting that labor force participation rate. Again, this is 1 month. We're not overly concerned about the labor market as a whole. The labor market, some of the other indicators still show that it's strong. It might not be as strong as it was, but we're not looking at recessionary type of levels here with the employment. One thing that concerns us from the spending perspective is that average hourly earnings actually grew at a lower pace than was anticipated and lower than last month. They're growing 3.2% on a year-over-year basis. So the real wages, if you take into consideration how elevated inflation's been, real wages have actually been negative for the 5th consecutive month. So we know the consumer's been resilient. We're just not sure how much long they can continue when we see these types of data numbers. So what does this mean for the markets? What does it mean for the Fed? The equity markets didn't mind this because it means that the Fed actually has a little bit of room. Maybe they don't have to raise rates in September. We think it's too soon to say that a September rate hike is off the table because, again, this is one piece of what the Fed looks at. And keep in mind, the unemployment rate is low. They still have a lot of inflation reports that will come out, and that's going to dictate what the Fed ends up doing in September. Bond yields are down. That's again because of the pricing out of maybe the possibility of Fed rate hikes. So the markets don't mind this too much. I guess you could say it's kind of like a Goldilocks scenario, not too hot, not too cold when you look at this report. So what does that mean? Maybe the Fed stays on hold. We still think we're going to wait for all that inflation. That's going to be the telling story. That's all we have today. If you want a history of our podcast, you can go to marketswithmegan.fm. Thank you.